Hi, and welcome back to Mike on Money. My name is Michael LeBlanc. I am Director and Portfolio Manager at Canaccord Genuity Wealth Management. And this is where we take a deep dive every week into everything financial. And this week we're going to be talking about a number one question that we get asked by clients and individuals is, what should I invest my money into? We broke it into three different parts this week. The first one was $1 million above, the largest sums of money, because they take very different strategies in those portfolios, especially to achieve diversification. We did one 100,000 above. Again, it's all about strategy and what type of product you want to be using to get the right diversification and manage your risk. And today we're going to be talking about, in this part, 5,000 and above. So kind of those who are starting out, those who are looking just to get in there and want to know what to do with the money. So let's dive into that here. Before we do, as always, don't take this video for advice. It's information purposes only. If you have specific questions you want to address, contact us or talk to a professional, or really do your own due diligence. The information here changes, and you want to make sure you have the most current and accurate information. Always do your due diligence or seek advice before you implement any portfolio strategy or investment strategy, especially for longer term goals. So with that, let's dive into things. And again, I apologize if you're watching all three of these videos. I have to say, the number one thing before you invest any money is to do a financial plan. Set your goals, figure out your risk levels. We did a whole video on that, so I'm not going to dive into that today, but it's really important you address that before you actually look or talk about investing. So I'll leave you to go watch that video and then come back and watch it here. So if you've got 5,000 above and you want to get started in investment, well, there's a lot of ways you can do that these days. You know what? Most people go out and start thinking about names, right? Should I buy Tesla, Amazon, Shopify, some hot name that's growing really well? And, you know, I always show concern to people when they want to take that approach. And whether it's a name that's already famous or one that they think is going to be up and coming famous, the challenge there is the odds are against you, especially when you're starting with your first lump sum. The fewer names you add to a portfolio. So if you have 5,000, maybe you're buying one name, maybe you're buying two names. You're not buying 25 names with that amount. And what that ends up doing is putting unforeseen amount of risk on your portfolio, that if something goes wrong, and there always is a chance that something can go wrong in any of these names, you're going to lose money. And once you've lost money when you're starting out, it can jade you for life. It can set you back, and obviously it's more, you know, that loss is going to be more meaningful to you in the short term than down the road when you've got the 100,000 or million, if you lose a couple of $1,000s. So it's really important to be really smart about when you're starting out and really think about, hey, am I willing to lose this money? Am I willing to go down to Vegas and say, black 16, here's $5,000? Because you kind of, when you're going with just a couple of names, that's your risk. So I really recommend you take a much more diversified approach. Take a look at think about it as a long-term, think about your long-term strategy that you want to apply. You remember that financial plan that you've done, and really go out there. One of the great tools you have out there is ETFs these days. You know, mutual funds are there as well. They're great. I'll talk about the pros and cons, but ETFs are fantastic because you can go buy one ETF and you can have a diversification anywhere from 5 different equities or positions, you know, up to 200 or more. So you can really diversify yourself. Maybe over diversify yourself. You want to be cautious of that as well. So you don't want to go buy 3 Canadian equity ETFs that all have, you know, 150 names each. You've kind of diversified yourself across the Canadian market, so diluted, you're never going to outperform the market itself. So you want to take some focused looks, you know, maybe a TSX 60, so the top 60 companies in Canada is a great one. You've got a heavy weighting on the banks if you want that in there. It pays a strong dividend, so cash flows are coming through. Really healthy for starting portfolios. Now you might not want only that. You might want to add some US in there, maybe some foreign with a different ETF. Same idea, go broad based. Don't go too broad. Don't have too many names. Some people want to have a little bit of torque. You can go the QQQ, which is your NASDAQ. That's your tech ETF. You can have gold, which is a XGD, which gives you a diversification of gold. You can buy all these as well, which are hedged to the Canadian currency, which takes currency out of it, which is another layer of risk that you might not want to have in there, especially when you're starting out. But it gives you a broad start as to how you can diversify your money and get some good returns going, but not risk that black 16 down in Vegas. The other aspect are mutual funds. Nothing wrong with them. They generally have higher fees, not always. They also have some strategies that can enhance what you're doing, especially from the tax side. A little bit at that level, probably not something you're going to be overly concerned about. Use your TFSA, put it into your tax-free savings account to avoid taxes rather than take it on the funds. And the real only reason is the funds have a higher fee structure. Nothing wrong with them. The managers are probably excellent, but if you look or you ask the right question, you'll probably be able to find that fund manager running an ETF structure, which is just a lower administrative cost structure. So it's just cheaper to you, which means more return in your pocket if you're saving on all those fees. So take a look at that. With that, I'm going to leave you to ask any questions that you want. Call in, email us, click to subscribe. If you have any other ideas that you'd like us to explore, send those in. We'd be happy to look at that. But remember, when you're starting out, make sure you take the appropriate steps to diversify yourself. Don't go too aggressive. You don't want to get burnt right out of the bat and or right out of the gate and leave yourself bitter and maybe set yourself back further than you'd like on your investment goals. With that, thanks as always, and we'll talk to you again next week.